So there's only two different types of people who actually invest in real estate, and there's a specific reason why. So in this video, we're going to cover exactly who those two individuals are, why they do it, and different ways that you can also invest in real estate without actually owning the property. So the two different types of profiles are going to be the users of that real estate and investors. So a user is somebody who actually needs to use the building for operations. This is really common with manufacturing companies or industrial warehouses and things of that nature. It could also be service-based businesses like accounting firms or attorneys who decide that owning the property is going to be a better investment or a better return than if they rented the property. Decisions for the users are more about location. Is it the right spot? Does it make sense monetarily? Again, is it more advantageous to rent or to own? And investors, well, they're actually going to buy the property so that they can get a return on their investment or a yield. Now, every investor is going to be a little bit different with their profile or their mindset, but some people are going to want a higher return and some people are going to want a lower return for different reasons. The investor mindset is pretty much thinking one of four things, and it has to be all four when you're looking at an investment. But when do I buy and how much do I pay for it? And when do I sell and how much do I sell for it? With those four different components, then an investor can actually calculate their yield or their return on their investment. And by the way, if you're a user or an investor and you need to find an agent or somebody who can help you actually look at the property, just reach out to us below and we'll get you connected with somebody. And yes, in all 50 states. Now, why? Why do people invest in real estate? Well, there's three major asset classes. We have our bonds, we have our stocks, and we have real estate. Now, when we look at typical risk profiles, bonds are considered to be really safe. Why? These are loans against either the government or big corporations where they say, hey, you give us this money, we'll invest it, and we'll pay you back an extremely safe rate. It's probably somewhere around 3, 4, or 5%. And the reason I do quotation marks is because it is based off of the federal rate. Now, stocks, on the other hand, this is us investing into these corporations saying, hey, look, we actually want to be a part of the upside. We want to see that higher return, that higher yield. And we can do it in many different ways. We can buy the individual stock like Apple or Google, or we can buy mutual funds or index funds that are basically a pool of different stocks and bonds that mirror certain indexes. But real estate sits right there in the middle. If bonds are considered extremely safe and stocks are relatively high risk, then real estate is somewhere in the middle. Now, there's a lot of data on it. You can look at something like the 10-year treasury bonds to actually see what the rates on the bonds were. You can look at something like the historical value of the S&P 500 or the NASDAQ to see what the equities or the stocks were trading at or what their returns were. And there's even something for real estate. It's called the National Council of Real Estate Investment Fiduciary, or the NCREIF. I guess that's how you pronounce it. But this is an organization that looks at over 6,000 different properties across the US in different markets and different categories like office, industrial, multifamily, retail, and so forth. And what they found is that the average yield of real estate does fall somewhere between bonds and stocks over the past 25 years. Now, if we think about why that is though, well, typically the real estate market is driven by demand. Obviously there's supply and demand, but see, it's a little bit different than bonds or stocks. You know, there really could be a demand for stock, but it's not a utilization of it like real estate. For example, housing. If people need affordable housing, then there's going to be an increase in demand in affordable housing. If the pandemic comes around and says everybody must stay home and be isolated and quarantined, well, then the demand for office space can greatly decrease. And so there's a different fluctuation with supply and demand that in return affects the price. However, with real estate, we have something on the tax side that allows us to protect other income. It's called depreciation. Now, this is a given with any buildings, right? If you have raw land, a little bit different story, but any buildings we can depreciate. And we do have some ability to control the rental income, which is really important. We can slowly increase value by increasing the amount of income that a property makes. So what are some ways that you can invest in real estate? Well, obviously you can own it privately. You can own a home, you can own an apartment complex, or you can join with others, becoming a general partner or a limited partner in these same types of property. You could also go and find a publicly traded REIT or real estate investment trust. They trade very similar to stocks, but the portfolio of what's owned is real estate specifically. Now, there's different industries and different marks, but these are known to pay extremely high dividends in comparison to other stocks. You can also invest on the debt side with commercial mortgage-backed securities. Now, as a reminder, the CMBSs were the reason why the 2008 financial crisis happened. But that's because they were poorly structured and they were kind of watered down and diluted and over leveraged to the max. Now they still exist, but with a lot more regulations. And so if you prefer that debt side instead of actually owning the assets like in the REIT, you could look at commercial mortgage-backed securities. And again, these are traded very similar to stocks or REITs in this case. Now, if you're looking for actual property to own it privately, or you're a syndicator or an investor that has multiple partners and you want to actually analyze one of these commercial properties, then reach out to us. We can be able to help you out. Now, if you're a business owner and this is what you do, it's real estate, definitely reach out to us. That's where we focus on as an accounting firm, and we can make sure that your books reflect exactly what it needs to. So when you are calculating your return on investment or your yield, you're getting an accurate number. As always, thanks for watching, and we'll see you next time.